So the third quarter of 2022, much like the first quarter and the second quarter, had its own share of volatility. But the stark difference between the first quarter, second quarter and the third quarter was that the third quarter had a large rally in it, a very large reversal from the negativity that you saw in Q1 and Q2. What we started to see was a lot of positivity coming back into the market, that central banks were not going to raise rates as aggressively as previously thought. A lot of people started buying a lot of the growth stocks, such as the NASDAQ index that had been sold off in Q1 and Q2. People came back into the market under the belief that things were going to be okay, that central banks were not going to raise rates because inflation was coming down. What that did is spark a large reversal in the S&P 500, in UK assets, in European assets, back to nearly where they were at the start of the year. So what you saw in Q3, rather than Q1 and Q2, which was negativity, you saw a lot of positivity coming back into the market. That prompted a lot of speculation from economists that this was a traditional bear market rally that you see in a lot of historic bear markets, and that the same thing was playing out in Q3. What we've started to see now is a little bit of that coming true. We've started to see investors realizing that central banks perhaps are going to raise rates as aggressively as they previously thought. And a lot of people that had that potentially misplaced positivity in Q3 that they could start buying growth stocks again have potentially come under pressure. And that's what we're starting to see. So as we're moving into Q4, people are starting to reevaluate that whole paradigm again about inflation and about interest rates. The main move has been that with oil prices selling off in Q3, that prompted a lot of positivity that inflation was going to cool. Now what we're starting to see is, with oil prices having sold off, inflation is still remaining very strong. And that's the thing that's starting to concern people, is without that oil price, inflation is still remaining high, and what are central banks going to have to do about it? And it's starting to cause people a lot of concern. So another area that we've been looking at in Q3 that we've seen is UK assets. The UK has come under a lot of pressure with the political turmoil that we've been seeing in the UK. You're starting to see a lot of focus on the pound, on UK assets, and the gilt market. In Q3, the gilt market has come under a huge amount of pressure in the last few weeks as investors across the world start to lose their conviction that the UK central bank aren't going to raise rates again and again and again to combat inflation, which is the highest in developed markets at the moment. What we're also seeing is negativity coming on towards the pound as well, under the impression that the UK economy is going to hit a recession, and it's going to be deeper and longer than many have predicted, and that the central bank are going to have to continue raising rates in that environment, which is traditionally known as stagflation, and that has caused a negative sentiment towards the UK, which has, for the majority of the year, been the outperforming equity market that we've seen across the world. So what we're starting to do is we're starting to see in Q3 and Q4 is the UK come under isolated pressure, and we need to make sure that we're folding that into where we're designing portfolios for Q4. Looking at portfolios, what we've seen in Q3 with the large reversal and rally in markets is that you've had to have been long, heavily invested into the equity market to outperform, whereas in Q1 and Q2, remaining defensively positioned has been your friend. A defensive position portfolio in Q3 has come under pressure because of the positivity that we've been talking about. So what we've seen is a very difficult environment in 2022 where you've had to have one type of portfolio for Q1 and Q2 and then a very aggressive portfolio in Q3, which obviously TAM has not followed. We've not allowed that positivity to derail our view. So we've remained defensively positioned through the third quarter, remaining underweight fixed income, especially government fixed income. We've remained underweight UK assets and European assets, and we've been heavily invested into defensive assets that do well under pressure, as well as having slightly higher cash levels, which we think is very beneficial. Looking forward into Q4, where do we believe markets are going? We believe that there's going to continue to be pressure, there's going to continue to be this hyper-focus on where central banks are going, on what they're doing, on how they're reacting to inflation. If I could watch two things in Q4 only, it would be inflation and where central banks are raising interest rates. Those two metrics are going to govern how the stock market and the bond market react, and therefore how portfolios are going to react. If inflation continues to remain stubbornly high, you're going to see a sequential reaction from central banks where they're going to have to raise interest rates again and again and again to get them under control. That is largely a negative for both equity market and bond market. Likewise, if we start to see inflation coming down and down and down, you're going to see renewed positivity that central banks won't have to be as aggressive as people think, and therefore you're going to start to see an acceleration in the equity market and in the fixed income market. What we need to do as investors, what TAM needs to do, is keep an eye on that paradigm to make sure that we are moving the portfolios in line with the market and, importantly, ahead of the market. But Q4 will remain, as Q1, Q2 and Q3, data dependent, and we'll continue to watch the numbers.